I used to get a lot of flack from silver investors, even when I was bullish on gold, because I used to think gold was a much better hold than silver. But I changed my tune to that, not because I'm speaking to you. It's been that way for several months now. Because of the industrial change in demand for silver, it may not be the monetary equivalent to gold, but it's certainly because of the improvement in its silver needs, should be close to a balance. I would not have a problem now when I used to say, well, I would have 75% in gold and 25% in silver. If somebody came and said to me they were 50-50, I wouldn't have an issue with that now.
PeterGrandich, a financial expert and analyst, brings a wealth of insights to the financial system. In this video, PeterGrandich now recognizes the increasing industrial demand for silver, leading him to advocate for a balanced 50-50 allocation with gold. Precious metals prices have weakened over the last couple of weeks, following gold's impressive plus 7% gains in October and silver's not-so-impressive 3% rise. Last month's gains for gold were mostly driven by safe haven demand, as the flare-up in the Middle East conflict saw investors rush out of risk-sensitive assets. Silver demand for industrial applications, jewelry production, and silverware fabrication is expected to nearly double over the next 10 years. According to a report by Oxford Economics commissioned by the Silver Institute, the demand in these three sectors is forecast to increase by 42% between 2023 and 2033. He also points out that central banks are setting records by investing heavily in gold instead of Bitcoin. Central banks across the globe are buying more gold, pushing the prices up. Major central banks around the world have been steadily increasing their gold reserves, which has boosted sentiment for gold, says the MOF's report. Gold price is set to decline for the second week in a row as Federal Reserve policymakers lean towards raising interest rates further. Meanwhile, Peter debunks concerns about rising interest rates affecting gold, highlighting its surge from $1,650 to $2,000 amid doubled rates. Now, we will present the clips of PeterGrandich's insights from his recent interview with Arcadia Economics. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Who has the money? Where's the money in the world today? Central banks, okay? Are central banks buying Bitcoin and all? What are they buying? They're breaking records buying gold. And what's most important, where growth is happening in the Far East and China and the BRIC nations, that's who's really buying it. Chris, let me just say one thing because I know how interested in silver. I used to get a lot of flack from silver investors, even when I was bullish on gold, because I used to think gold was a much better hold than silver. But I changed my tune to that, not because I'm speaking to you. It's been that way for several months now. Because of the industrial change in demand for silver, it may not be the monetary equivalent to gold, but it's certainly because of the improvement in its silver needs, should be close to a balance. I would not have a problem now when I used to say, well, I would have 75% in gold and 25% in silver. If somebody came and said to me they were 50-50, I wouldn't have an issue with that now. I think when we do turn here and we get out of this vicious bear market, they'll have similar percentage gains. And quite frankly, once we do break out and we see this tremendous breakout from a cup and handle that both gold and silver have going back 10 years, when that breaks out, silver would tend to rally because retail will be more involved. And retail always likes things lower price that they can have more quantity on than higher price and less. And that I think will aid silver then. I wouldn't hold back and say, well, I love gold, but I'm just so on silver, which used to be a comment that came out of this mouth, but not anymore. I think they deserve equal time. Well, let me quickly jump on something you just said, which is critical, because if you go back to last year when it was 1650 and the many gold bears, or what I call weak knees bulls, and these are guys and gals that switch from bullish to bearish no matter which $50 way the gold went. They were all saying, well, gold's trapped. The interest rates are going higher, and with interest rates going higher, that's bad for gold. Well, gold managed to go from 1650 to 2000 with interest rates doubling. So I think that argument is not a worthy argument to have, and I don't have that fear. I'm still not in the camp that thinks we peaked in interest rates. I still think we will get above 5%. Maybe not be to next year, whether there's a recession or not. But I do think another important thing about gold is this. We learned now, for those that watch it like you and I, that there's a paper market, and then there's a physical market. And what I always find interesting, and the good news in all of this, well, let's go back 20 years. I used to argue with a certain guy that used to be the spokesperson for a certain website. And we appear at the shows, and we used to call him Tokyo Rose was his nickname, because he was always telling us about the end, gold is going down, and we couldn't understand. He's working for a website that sells gold, and he's always bearish. Anyway, he called us tinfoil hats and all us guys, Gatter and these other folks that used to be around, that we said there was manipulations in the markets. Well, guess what? Over the last 10 years, we saw charges. We've seen people found guilty. We've seen people admitting it and all. And one of the good news in that is it's not anywhere as bad as it used to be. Now,
During the interview, PeterGrandich mentioned the waning dominance of the U.S. and the rising influence of the BRICS nations, notably China. Given recent harsh criticism of U.S. currency policy by officials in China, Russia, Brazil, Saudi Arabia, and elsewhere, it appears that the dollar's uncontested reign is ending, with far-reaching global economic consequences. Moreover, he underscored the ongoing shift away from the U.S. dollar in international trade, suggesting an imminent acceleration of this trend. The BRICS nations have aimed to decrease reliance on the U.S. dollar for over a decade. The current Ukraine war and Western sanctions on Russia have accelerated this effort. On August 23, Brazil's President Luiz Inácio Lula da Silva proposed a common currency for trade and investment among BRICS nations to reduce vulnerability to dollar exchange rate fluctuations. Let's get back to the interview.
we're going to have some sort of major beyond crisis that anything, depression, whatever, didn't compare to. How we choose to get out of it is a few ways. I say it'll be probably a combination of all of it. One of the things I think that's going to push us over the line, and I've been talking about it before it became main news, and still most people on Wall Street, or what I call the don't want to be happy crowd, scoff at it. And that's what's happening with the BRIC nations. And why people, Chris, shouldn't not take it serious is you have to understand that up until 10 or 15 years ago, America dominated the world in many ways, including in trade, fiscal, handling, and dealings. When I started in the business, we were the world's largest credited nation. Hey, when I started in the business, there was less than $1 trillion in long term debt. But the bottom line is this is a serious movement. It's real, it's growing, and most recently had vaulted up several levels of uh, concerns I would have by the Saudis offering to join it and also making it known that they'd be willing to trade in oil outside of the dollar. Now, we can go into a long discussion about that, but younger people need to know that there was a time that we basically made an understanding with that country that we'll give you protection as long as you price things in dollar and favor us with your oil. And that was after the oil embargo in the 70s. The bottom line is when Biden last went over there and basically PETO'd the people in charge, that's when I think that and the combination of China showing up at their door and coming with sweets and flowers, whatever else it took, that was the dramatic change for the BRIC movement, and now we're going to see that accelerate. And once the U.S. is recognized is not the dominance on world trade, and it's being shut out or it's being limited, and there's an alternative. Now, I'm not looking for them to announce a new world reserve currency, but I do believe they're going to come up with a way that they can trade among themselves without using the U.S. dollar. And that's significant in itself because once they don't need the US dollar, those dollars still exist, Chris. And I'm sure you've had people on there, and I'm sure this is something you covered. But most people don't understand this in the regular investment world. Those dollars got to come back home. And when you have too many dollars chasing too few products, that's inflationary. So my argument is whatever happens will happen in a very strong inflationary process, not something where everybody's down to eating apples and a depression so we can, and they dead. It's going to be done in an inflationary environment. Inflation's behind us, or we're going to be back at 2%, and the Fed's going to be back to putting the pedal to the metal. I think we're past that. I think that's one of the reasons rates kept going. Remember, people just look back early in the year what those experts on those tout TV networks were saying. When the long bond hit 4%, oh, this is a gift. Inflation's going to go back down and so forth. Now they say, oh, 5% is the top. Why I think we got here and why I still think rates can go higher even if the economy slows, because it's coming much more challenging to be a borrower now versus the creditor. And the United States is the borrower. I don't see interest rates going substantially lower again. And without going lower, that doesn't mean I see them going up higher. They're just not going to go lower. And without that mechanism and all this grooming that investment advisors who came to work in the last 20 years just knew that the Fed always saves you. And boy, we always bail ourselves out.
The evolving dynamics, including silver's industrial surge and central banks' gold investments, present a multifaceted outlook for investors. Gold trading above $10,000 and silver near $300 is where President of Financial Sense Wealth Management, James Puplava, sees prices later this decade, according to his big picture update titled Unsustainable. How do you see precious metals evolving during global economic changes? And what factors will impact their future values the most? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.